Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 30 minutes here. All right. Well, the markets, I don't know. Was the news good last week? I guess so. As far as jobs are concerned, there was a lot of question marks about when the data was posted and if it's a really reflective of the true job scenario. But in general, the market took it as a good thing. Market is kind of a little tipsy right now. If you just actually look at the S&P 500 index, you'll note that since Liberation Day and the downturn of the market, based off of the news about tariffs, the market has came climbing all the way back, and we're now sitting in the SPX and the NASDAQ and even in the Russell, all at the pretty much the same levels as where all of this began. So in other words, if you went on vacation at the beginning of April and you just got back, nothing really happened. So interesting enough, except for the VIX is higher, and we did a VIX trade, and I do need to look at that VIX trade. I actually need to pull that up and figure out where that's at, because that trade, we probably want to get out of it. It was going out to mid-May, and I'm sure it's doing just fine. The VIX is currently at 22 on the spot. We sold something around the 28 or 29 strike and did it for a healthy credit. So that turns out to be a really good trade overall. I did that one personally. I've already taken the trade off. So we need to go in and look at that trade. With the VIX, if you can get a trade off and collect half the premium, you do it, mainly because the VIX is just such a wild beast when it comes to the actual volatility of the volatility index. So PLTR is going to be announcing earnings after the close today. So I'm going to start there. And then also we're looking really solid on our Netflix trade that we talked about on Friday. And it's more so that just the market is getting a little bit overbought. Strong moves to the upside. If I were to make a bet on the direction this week, I think the path of least resistance is to the downside. We do have a Fed meeting. Anything can happen with that, but it's highly anticipated that they're not going to move in either direction on the Fed meeting. Obviously, if something were to happen there, you never know with the comments how that could drive the market or not drive the market. Usually the Fed's goal is to try to not upset the market when they are having their meetings and speaking, but sometimes it does happen. So I think I'm going to start off with PLTR, and let's show the Tradier Pro software. And in this instance, PLTR is announcing earnings after the close today. The expected move is about 17 points. If you buy a little bit over. If you buy the 123 May 4th expiration, if you buy that, you are 17 points, $17.15 or 14%. So I do ask the question here, because PLTR, the chart is extreme. It's just like everything else that has happened in the marketplace as far as SPX, NASDAQ. I talked about all of them, the downturn, and now they're all the way back up. So right here, this is really on a precipice. And I got set up to do a bullish trade because I feel like the earnings will be solid. Like a lot of the companies that are announcing right now, the trade wars haven't really hit. They've given guidance, across the board. The guidance, I don't know, it's been mixed, but I think it's leaned bearish. But so far, the companies that are giving guidance, I feel like that's the case. But look at this chart, right? All the way back up to this level right here, right at 123. And they're announcing earnings today. So, I mean, where could the stock go? The stock could go all the way back down to the bottom of this steep mountainous climb, all the way down to the 100 level. The expected move is about $17 by this Friday. Remember, it's always based off of the nearest term expiration, which would be this Friday. And so that's about a 14% move. So that would be a larger move. That'd be almost a 1 standard deviation move. But there's a lot going on right at that 100 level. But if we break out to the upside, then, there's no, where are we going to next? There's really no limit on the upside. So the fact that it's all the way back here, I'm leaning bullish on the trade, but something's definitely going to happen right here, right? Very interesting chart. If you have any comments, you know what? We'll look at it both ways. I'm going to set it up bullish, and then we'll actually look at the Netflix trade, and we'll talk a little bit about that trade. But I'm going to set it up bullish. If you have any comments or you want any suggestions, if you want to opine on the chart that I'm showing you, feel free to do that. Just do that in the comment section, and I'll be happy to address any questions that you may have. And I'd like to know, where do you think the PLTR is going to next? I have a feeling like the earnings might be a catalyst, and we might break to a new high. But the marketplace in general, the VIX trading at 22. Let's see where the SPX is at right now. We got the Russell 2000 is flat, so the market's still, even though it opened down, it's doing fairly good right now. SPX down 1/3%. NASDAQ is almost, 0.42%, down 84 points on the day. A little bit of negativity in the marketplace. All right, here's the butterfly I was going to do. I looked at a skip strike butterfly, not a big enough nut credit, and I didn't really like it that much because the net credit I was receiving was about 22 cents. Even if you were to sell a short spread, it's still not a lot of money that is received as opposed to the skip strike butterfly. That's why I say that. So I'm going to set up a butterfly, and we're going to do one on the bull side, and we'll do one on the bear side too, because like I said, it's at a precipice, and I'm leaning bullish at this point in time. The May 4th expiration is here. And also when you're looking at a skip strike butterfly, I'd rather have PLTR announce earnings on Thursday than on Monday. Because you have that risk. I want that trade to go away right away. I want to get as much premium as we possibly can, like we did on the Netflix trade, which we talked about on Friday. You know, that trade is looking very solid right now. And we got a good premium for the risk. We got a decent risk reward situation, and that wasn't even around earnings. Okay, so here's what I'm looking to do. I didn't click the last trade. So we're going to do an open wing butterfly. We're going to buy the 125 strike. So we're going to get this premium right here. We're going to sell 2 of the 135 strikes. Now, this is fairly inexpensive because of the pumped up implied volatility, right? Because of the earnings. 161 is at the money ball. The historic vol is 83. So it's a decent underlying just in general with that type of volatility. Now you could buy this outright, and let me go and put this down because I want to do the comparison here. So you're talking about $3.65. And I don't mind just buying this outright, because if you look at the chart, once again, we go back to that, and we do get the catalyst to move up. That if we can finish like 125, 126, somewhere in that range, and have a solid breakout above this high. What is that high right there? 125. All right. So if we can get a solid breakout above the 125 level after earnings, and like I said, 17 points is what the expected move is. I don't mind this out of the money butterfly, right? Because we're within the 17 points, or not, I'm sorry, bull call spread, because we're within the 17 points, 125 to 135. So we're talking about a 10-point move. And so it's very feasible to get there, and you're paying $3.65 for it. That's $365. If the market goes down, you're out of luck. It's not like implied volatility is going to get cut in half more than likely, and it's going to end up right around 30 or 83% implied volatility. So if that goes down, you're not going to have many options to get out of this position if that does happen. So to reduce the risk a little bit more, but not quite get as much upside, there's always a trade-off. We're going to sell one more of these, right? And this is 5 points wide. And then if we go another 5 points here, and let's go Let's see how much we drop off if we go 8 points. Then we got 2 points. We'll go 5 points. Let's try this out. Okay, 235. So you are going from 360 down to $2.35. You still have the upside from 125 to 135. You're still looking good. You can still make 10 points on that. The risk kicks in at 135 to 140, but if it goes beyond 140, you can still make an extra $5 minus the two, we'll call it 240, or $2.60. So this is an open wing butterfly in that this distance is 10 points and this distance is 5 points. So is it worth $1.20 in risk to give up some upside if it blows the numbers away and breaks all the way up to the 140, 145 level? In my opinion, yes, it is. I'd rather reduce the risk and give myself some upside. So let's send this to the what if calculator. And this is going to be the official paper trade. I will do it on the downside. If you think that that is going to be a strong resistance level where it's at, feel free, and we'll adjust it on the downside. It'll probably be a little bit more expensive because vols will be a little bit skewed. That way out of the money put will cost us something. But this is what I mean by the open wing. If you notice here, so it's saying that, well, I said 260, right? So you got to keep your eyes over here for the profit and the loss. And if the market does go down by Friday, or it goes up by Friday, and it blows through your strike, the 140 strike, you're going to pay 240 for this, and you can make about 260 on the upside because this will be worth $5. And that's because the long spread in our butterfly is 10 points, and the short spread is 5 points. All right. Now, once the market opens up, we're on, it'll be a Tuesday. You're still going to have 3 or 4 days for it to live. So this is the profit and loss graph right now. So it doesn't look too rosy until that implied volatility gets cut in half. And then it'll probably come in and land somewhere around in here. But this is day one of the trade if we put it on today. And that will start drifting that way. So once again, I'd rather have them announce even on a Wednesday or a Thursday. But I'm not doing the skip strike butterfly because of this risk. I want to have a defined risk and solid upside. So the maximum that it could trade for, if it went right out at that strike, would be 10 points minus 240. So you're talking about 760 is what the maximum would be. But you'd get extremely lucky if that would happen. More so, I'm looking to try to make a couple of dollars. I'm paying 240, hoping to sell it for 5 or 6 and get out of this trade. And that's the way that I would approach it. Now, you can buy the options outright if you do think that it can make that move to the upside. You could buy something right here. Gosh, I guess if you're going to pay the same amount, how far out we got to go? To get to 240, we got to go a 1 standard deviation. This is the delta's 20 on this, not quite. So 144, and then you would be paying about the same amount as you are for that butterfly. But the market's got to open somewhere near that. So I like this trade. Pumped up implied volatility. The options get cheap. So as opposed to buying a call option outright, as opposed to doing a bull call spread, which was $3.60, we're going to look at doing an open wing butterfly for $2.40. That'll be our max risk. Realize this is a very risky trade, so pick your contracts accordingly. And it's not always meant to be a recommendation. I don't know exactly what risk tolerance you have in your portfolio, but if you're paper trading it, you also want to make it realistic. So if you've never done an open wing butterfly, this is a very interesting underlying to do it on. The chart is extremely interesting where it's at right now. And if you did get to break out to the upside, you might, think about buying the stock because, you're right at that precipice as far as the chart is concerned on the recent high. All right. Any questions on this? This will be the official paper trade. Well, we got it. We sent it to the what if calculator. Okay. Now let's go and clear this out. And if you want to get bearish and you think that this is going to act as an area of resistance to the upside, let's clear it out. We'll do something very similar here. We went 10 points wide. It's going to be a little bit more pricey on the put side. 240 is what we paid. Let's see how close we get. We'll go 122. We'll buy this. We will go 10 points down to 112, and we will sell 2 of those. And then we'll go 5 points down to 107, and we'll buy 1 of those. It's froze right now. 271. Okay, so we're a little bit more pricey. We went from 240 to 271. And to explain the price difference, it has a lot to do with the cost of this option contract. So in general, when you look at volatility, the puts will hold the vol on the upside. Vol is pretty solid throughout, 160. We run up this way, you see that the vol is 158, right? So your way out of the money call option, you're paying less implied volatility than you are on your way out of the money put option, which is 160. And that's the difference. And that ends up being 30 cents approximately. So if you want to get bearish on PLTR, it's going to cost you 30 cents more to do a similar trade. And I guess I'll send this to the what if calculator, and we'll look at that trade too. And so now you have the downside. Market's right here at 123. From 122 on down, you got, first of all, day one. Same thing here. It's open winged. So we're going 10 points wide on the bear put spread, the put debit spread. And we're going 5 points wide on the bull put spread, or the short put spread, or the put credit spread. And from here on down, it's showing you that's where your maximum is at. If you could get it executed for 270, you would make 230 if the market went down this range and landed somewhere way beyond your strikes in this instance. Expiration is this Friday, still May 9th. Yep. In that scenario, and no comments. Okay, so let's go back then. The official paper trade is going to be on the call side of things, and we're hoping that the earnings report is a catalyst to the upside. The market's leaning bearish a little bit at this point in time, so you got a little bit of headwind there. But with that said, they're announcing after the close today, and I think I would lean bullish on this trade. Want to do a reduced risk trade, and we're reducing our risk as much as possible by trading a 3-legged open wing butterfly. Okay. Next. So let's grab the Netflix trade. This is the trade that we set up on Friday, and we're going to send that to the trade ticket, and we're going to go back over here and put in Netflix. So our expiration is the 16th, which is 11 days away. And part of the reason why we could get it done for a net credit is that, or for a decent net credit, is that we did go out a little bit further in time. Wouldn't want to do this type of trade with earnings and go out. I guess this would have been about 14 days, right? So with earnings, you usually try to do the shorter term one when we're doing the skip strike butterflies. Always talk about Amazon always has a tendency to announce on a Thursday before the Friday expiration. So that's always an interesting one. Apple did it this time around too. They had that same type of trade. They announced on a Thursday before the Friday expiration. But now that Netflix has already announced, and the chart is, and this is what drew us to Netflix, a little bit overbought, I would say, right? Like, look at that ski slope there, right? That's just crazy. And we did get a little bit of a move up, and now we're back down, and we're trading at the 1,132 level. We put the trade on for a real solid net credit. We received $1.43 for the trade. Market is down a little bit. I expect this to be trading at about $1, but I guess it's 85 cents. All right. So it's trading at 85 cents. We are up, we'll call it, and now it's $1, right? Yeah, I said $1. That's where my guess was. So we're up 40 cents on the trade. Let's leave it there. And this is a decent scenario. I mean, we'd like to capture the fact that we could do this entire trade and get it done for a net credit of $1.43, and our risk on the trade was 10 points, which is the skip strike. So let's go back to here. Let's go back to the what if calculator. So our risk is, see, it says $900 there. So this is based off of today, and it's saying that we're getting it done for $1 net credit to the account. So the risk there would be $900. Ours is a little less. It would be $860. But the risk is that the market moves up beyond our short strike and starts drifting higher. So if the market hangs around right here and we're getting a little bit of time decay, and as expiration approaches and it starts drifting up towards our long strike, that's totally fine in this trade. We just don't need a catalyst that will blow it through the strike, through the 1,200 strike and beyond. So as long as we don't get that catalyst, and that's a nice big round number, the 1,200 strike, and you could actually make more than that $1.43, even though that was our real goal, is to try to bring in the net credit and capture it. And this is our hedge. But the way that Netflix is trading right now is almost, well, it's perfect until it's not, right? But this is the type of move, you're a little bit up on the trade. It hasn't blown it away. There's still potential that it could come back. If you landed somewhere between these strikes, that would, good luck on that. That's a low probability that's going to be right in between that. But we're okay with that. Even if it starts moving up a little bit, we might be able to put this on for a net credit and take it off for a net credit. So if it starts drifting over this week back up to 1,180, this butterfly might be trading for a higher credit as long as it's close enough to that expiration date on the 16th. All right. Any questions on that one? All right. Well, we're going to finish on time today. Like the Netflix trade on Friday, mainly because of the chart. Really like the movement in the stock today. Palantir is a crazy trade. We showed you a way to get bearish or bullish at a minimal cost. Didn't want to do a skip strike butterfly because I think there's just too much risk where Palantir is at, right? I mean, as a matter of fact, buying the straddle would be interesting right now to me. I have a feeling it's going to move more than 17 points after the earnings announcement going into Friday. That's the expected move. That's the at the money long straddle, buy the call and buy the put. When I started the show, it was at $17.15, which is represents about 14% movement. And don't forget, expected move doesn't have anything to do with direction. It's just saying based off of those prices that people are willing to pay for the call or pay for the put, the most at the money option contract. The marketplace is saying that a potential move of 17 points is feasible. And I always like to look at it as an over under on a total. If you're thinking of a sports book, betting on the total points scored in a football game. This is a lot of money's coming in, buying at the money option contracts. And based off of what they're willing to pay for those option contracts, we come up with something we call the expected move. All right. No questions, no comments. All right. That's going to be it for this edition of Options Guide TV. Thanks for stopping in. And we'll see you this Wednesday and find out how the Palantir trade worked out, and hopefully Netflix just kind of hangs around right where it's at. So with that said, thanks for tuning in, and we'll see you this Wednesday, 11 a.m. for the 11 a.m. Eastern time for the next edition of Options Guy TV. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.